Nice to see you, Bob.
Good to see you. How are you, Katie? Everything all right? How's the summer going?
Yeah, summer's going great. How about you?
Great. The reopening is proceeding. The Delta variant's a little bit of a curveball for everybody to deal with, particularly at the New York Stock Exchange, which is a microcosm of what's going on around the country. But it's been good overall.
Good. Well, I'm happy to hear that. And we're definitely going to get more into the Delta variant and what that means for the market. But why don't we start off with the jobs report? Can you tell us a little bit about what today's jobs report means for the market?
Well, the good news is growth continues. The market's concerned about a couple things. It wants to be assured that the economy is going to continue to do well. This whole peak everything story that, it's the peak of the economy, the peak of earnings in the second quarter, and from there it's a slow descent is probably correct, but you can still have significant growth. It just means it's not going to grow as fast. And remember, we're coming off of a last year for the height of the pandemic. So today's job report was good. It confirms there's still growth out there. It was collected, a lot of it at a time before the news of this Delta variant thing spread around. So we still don't quite know the impact on people's behavior of that. We can talk about that in a minute. But since the report came out, interest rates have moved up a little, and I think that's a good sign. Rates bottomed in the middle of July. There were a lot of people concerned about what did it mean that interest rates kept moving down. A lot of people bet that this is a sign of slower growth, possibly. Remember, there's a lot of people overseas buying our bonds. Japan's bonds are zero at 10-year yield. 10-year bonds are 0%. Germany's are negative. So ours at 1.2, 3, 4%. That's a relative bargain. So there's been an awful lot of foreign buying. At any rate, the jobs report was a little higher on interest rates. I think that's a good sign. It does bring back issues about when the Federal Reserve might stop its tapering program, its bond buying program. But I'm perfectly willing to engage in that discussion. I think interest rates should be a bit higher. What does that mean for the stock market? It's generally positive for what we call value stocks, energy, industrials, materials, what we call cyclicals. It's generally a little less, higher interest rates generally are not as positive for technology stocks. And the reason that happens is there's a model of valuing stocks called discounted cash flow, where you have technology stocks that are growth stocks, and the value of that is in the future stream of earnings that they throw off in the future, 3 months, 6 months, a year, some cases 2 years, 3 years down the road. When interest rates go up, that's an alternative to investing in these growth stocks. And so the value of that future stream of earnings for tech stocks, particularly if they're not making any money now, but you think they will in 2 or 3 years, the value of that future stream goes down because there's alternative investments that are out there that would compete with those stocks. So interest rates going up generally is not great news for growth stocks, though it doesn't necessarily derail them. So overall, I'm pretty happy with this report. And I think the big thing here is the Delta variant. And we can talk about that a little later, but it's still not clear what's going on with that.
All right, thanks, Bob. So the next question that we have is about Robinhood. We've seen a lot of volatility. So what's going on with Robinhood stock this week?
Well, Robinhood has sort of become a meme stock again. What is a meme stock? Well, it's a stock that attracts a lot of retail attention, enough so that it significantly moves the price of the stock. I think highly of Robinhood as an organization. I think very highly of the fact that they have 22 million users, most of them young, most of them with very small amounts in the accounts. 22 million is a lot of users. Schwab has 32 million. Vanguard probably has 38 or 39. So does BlackRock, Fidelity. 22 million is a pretty good number. Now, the value of all those accounts is very small because the users are young compared to the value of accounts that are, say, at Schwab or Vanguard. But that doesn't matter. I think they've done a great job, despite some hiccups, obviously, that they've had. Valuation is another question. What's the company worth? Here's the problem. When you have a company that goes from $33 on its after the first day of its IPO to $80 in a few days, that is not. There's no fundamentals that are involved there, and I don't care if Cathie Wood buys into it. there's something else going on. So what are you getting when you buy Robinhood at $80 or $70 or $60? What you're really getting at those kinds of prices is a volatility play. It's a call option, essentially. Just like AMC, when AMC went crazy, AMC, when it went crazy, was not about whether the movies were going to turn around. It wasn't. It was a volatility play. GameStop, when it went crazy in January and February, was not about whether people were going to go out and buy more video games. It just wasn't. That was a play on volatility. That was a call option, a bet that you could make a bunch of money pretty fast. Now, maybe you still can. If you'll notice, all the analysts who cover GameStop basically threw up their hands and said, I'm not doing this anymore. The analysts gave up because it doesn't make any sense. So you have what are called fundamentally insensitive traders and investors who don't care about what the actual fundamentals are. They're trading the stock because they think something's going to happen. They think, the price is going to go up, and that's fine. There's nothing wrong with that at all. But you just have to understand what you're dealing with. So people who are fundamental investors ask me about this all the time, and I say, well, if you get a group of people who are indifferent and don't care about fundamentals, and they're a large enough group that they're a significant part of the trading activity, why should the stock trade on fundamentals? It wouldn't, and it won't. At some point, I always believe fundamentals do matter somewhere down the road. But if you ask me to tell you when on certain stocks like the ones I just mentioned, I don't know. But as a company, I think highly of Robinhood. On the stock price, that's where we may differ.
Thanks, Bob. So another topic that people are really interested in is Bitcoin. So I was wondering if you could tell us a little bit about where things stand on a Bitcoin ETF.
Yeah, unfortunately, this was not a great week. Gary Gensler, the head of the SEC, a lot of people had misperceptions about him. People stupidly thought that he was going to be the golden boy for Bitcoin, that because he taught cryptocurrencies at MIT, he's going to get it and approve it. Turns out, no. And I'll tell you why this has happened. People have failed to understand the difference between a guy who teaches crypto at MIT and a guy who is suddenly the head of the SEC. Because suddenly, the head of the SEC is a very different role and responsibilities than some guy who's teaching crypto at MIT. The head of the SEC is empowered to protect investors. That's the mandate of the SEC. If you don't do that, you're not doing your job. Gensler's got a very different role now than when he taught at MIT. Gensler this week gave a speech on crypto and very cleverly positioned himself in two ways. Number one, he said, I'm a champion of financial innovation. I'm in favor of it. We got to keep doing that to move forward. And we have a history of financial innovation in this country. Right on. Then he also said, can I point out that there is no regulatory control of, for example, crypto exchanges? Well, that's critical, understanding who's the regulator for them if we're going to move forward with cryptocurrencies, whether they're tethered or whether, they're things like Bitcoin. The implication was, I'm not in favor of a Bitcoin ETF right now because it's priced off of exchanges that are not regulated. That was the implication. He didn't directly say that. Now, he did say, you know what I would look favorably upon? A Bitcoin futures ETF. Why? Well, futures are regulated. It's a futures market, CME, those kinds of things. And obviously, there's a bit of cover that he's being offered, or not offered, but that he sees between approving a Bitcoin ETF in a futures market, which is regulated because Bitcoin futures are a regulated market, and the ETF. Does that mean he will not approve anyone who tries to go out and just buy physical Bitcoin? I think the implication is pretty clear. He's going to approve a Bitcoin ETF that are based on futures, but not immediately one that would be based on owning Bitcoin directly. The problem, of course, is a Bitcoin ETF futures is an inferior product because futures have to roll over, and there's very high cost. And they don't necessarily always track Bitcoin. So from the point of view of the ETF community, a futures Bitcoin ETF is inferior. And it's not going to get anywhere near the uptake that owning Bitcoin would have. Now, the optimists keep telling me, okay, well, it's a step in the right direction, Bob. I'm going to have on some guests on Monday on ETF Edge, Michael Sonnensheim, who's a well-known Bitcoin advocate, and they run the Grayscale Bitcoin Trust. Some other people who just got approval to run a Bitcoin futures mutual fund will be on from ProShares. And if you want to hear more about this, tune in on Monday at 1 p.m. Eastern Time, etfedge.cnbc.com, etfedge.cnbc.com, and we'll go through all of this. But the bottom line is Gensler has made it very clear, unless I get some control, regulatory control over these exchanges, I'm not doing anything. And he's right, by the way. It is a little bit dangerous for him just to go approve things when we don't have any regulatory control. So what everyone should do in the Bitcoin community, in the ETF community, is go and lobby Congress to give Gensler regulatory control. He wants the authority. There's a little bit of a turf war that'll happen here. The CFTC, the Commodity Futures Trading Commission, may feel they should have regulatory control. It's a little bit of a food fight, but Gensler's right. Let's figure out exactly who the regulators are here. And by the way, it's not going to be no regulators and let's do the Wild West. That ain't going to happen. Certainly not with a Bitcoin ETF. You're not going to get it without it. So sorry to inform everybody, but it's pretty obvious what needs to be done at this point.
Yeah, well, it'll definitely be interesting to keep watching and see what happens there. So thanks, Bob, for that. Our next question is, what does China's regulatory crackdown mean for investors?
Well, this is a really hard one. Overall, it's not good. And the reason it's not good is that there is a much higher degree of regulatory risk. You know, there's all sorts of risk in owning stocks and owning bonds, and you can list them. Regulatory risk was fairly low on the list, and it turns out it's higher than we anticipated. Partly it's higher because there's a certain amount of animosity between China and the United States, but that's only part of it. Part of this is there are Chinese stocks that list here in the United States. U.S. auditors have not been able to access the books there in China to verify what these companies are saying because the Chinese government will not allow it. They consider that to be a state secret, particularly for companies that are state. So that's been a regulatory impasse, but it goes deeper than this. The Chinese government at the very top is trying to assert much more control over its companies in general. There's two reasons for this. There's an ideological reason. The current leadership there believes perhaps a little less in free enterprise and more in state control. There's a deeper regulatory reason. They're rather concerned about situations where you have corporations that are so powerful that they could represent a threat to the economy. I'll give you an example. Ant Financial was a major problem for them because Ant Financial, you were essentially able to apply for loans in a chat in a messaging service. Essentially, that's a major problem because you have essentially a non-bank company that's going out and acting like a bank, and the Chinese regulators were concerned about this. That this was enormous. And you know what? They're right. I mean, the United States regulators have problems with this too. So on the one hand, I think there's a serious problem with the ideology of the Chinese Communist Party inserting itself into the part of capitalist China that exists. And on the other hand, there are some points about these companies getting so big that they want a little more regulatory control over them. So here you have a real problem. The world has gotten easier to invest in thanks to passive investing, indexing, the growth of indexing, and the growth of ETFs. So people have been spending more money investing overseas. It's easy to do. You can buy, into Vanguard International Fund. You can buy into the emerging markets ETF. And China is a significant presence. It's 40% of the EEM, the major emerging market ETF. Okay, so you are invested sort of by market capitalization to a certain extent. But what happens if there's more regulatory risks? Is China still investable? Should we consider China a different part of the world? Is it you invest in the U.S., you invest in the rest of the world, and then you invest in China? Is it like a third asset class? This is what the debate is right now. Is the regulatory risk so high that you have to consider China a sort of separate asset class? And the answer is, I don't know. It's not clear to me. And it's hotly debated right now. So we'll have to see. I think that in terms of the indexes, the index companies like MSCI, they don't care. They'll do, the invest in the world ex-China ETF or index if they want. They're kind of neutral on all of that. But other people, care greatly. My sense is that you can still invest in China, but you have to understand what the risks are. That might mean you invest less than what China's market capitalization is. Maybe you shouldn't do that. This is the kind of debates that are going on right now. But the world is big. And investors, rightly so, want a sense of having some part of the world outside of just the United States, even though U.S. companies are very involved overseas. It's a very interesting question right now.
All right, thanks, Bob. So next, I want to circle back to COVID and the Delta variant. How concerned are you about the Delta variant's impact on the market?
Well, I am concerned, and I'll tell you why. The current narrative is for the market is the COVID variant will slow but not derail the economic recovery, and I think that's correct. I don't think we're going into big lockdowns or anything like that. I don't think that's going to happen. It's not going to be anything like last year. That's good. However, the word slow can encompass a lot of things. It could mean slows a little or slows a lot. The question is not a lockdown. The question is how much of consumer behavior might change. And we don't know because this awareness of this is really only a little more than a week old. So there's a lot of people who are asking questions about what you can and can't do. It is a little worrisome that I, as a vaccinated person, might come in contact with someone who's unvaccinated, and I might have a viral load as a result of that contact. I may not get sick, but if I go hug a kid, I could infect him. There is some evidence that could happen. That's a little worrisome, obviously for the school-age population. So people are asking those kinds of questions. It's very difficult to determine how much your behavior you should change. So I'll give you an example. Suppose you want to go to a club, or you want to go to a comedy club, or you want to go to a jazz club or a rock concert where it's indoor and people are very close together. Should you go? It's not entirely clear. You should certainly mask up. Should you go to an outdoor concert? I wouldn't be that concerned about doing something like that. All right. How about, a Knicks game at the Garden? Most people would not be concerned about doing that, but these are the kind of questions certain people are asking because of the high transmissibility level of the vaccine. So again, I don't believe we're going into any lockdown, but I do believe it could alter people's behavior in subtle ways that will slow the recovery.
Yeah, for sure. It'll definitely, again, be interesting to see what happens, and hopefully things get back on the right track. So my next question is, what kinds of stocks should a new investor look to start out with?
Well, I don't make recommendations on stock investing at all, but I can tell you the person who had the biggest influence in my whole life was Jack Bogle, the founder of Vanguard. I met him more than 20 years ago, and he had a huge impact on the way I look at the stock market and the way I personally invest. I've made no secrets of the fact that I'm a Jack Bogle disciple. I own mostly passive index funds, like the S&P 500. I have for 20 years. And I've been very happy with that. I can't own individual stocks because of what I do, but it didn't matter. Even if I wasn't doing what I do now, I'd still do the same thing. And I think for basic investors, people who are just starting out or young, and I've done this with my nieces and nephews, owning an S&P 500 and a small mid-cap fund is the way to go. If you have strong opinions, or you want to watch CNBC's active trading shows, which are terrific, by the way, and you want to do some real research, wonderful. Knock yourself out. I think it's fantastic. And you want to buy some individual stocks, go ahead. I still recommend most people, their core holdings should be passive index funds, long-term, like the S&P 500, like an S&P small cap. Or S&P mid cap. They're readily available in all the mutual funds, families, Fidelity and Vanguard and BlackRock. So that's, I think, should be the core of anything. If people ask me all the time, the professionals basically say, if you want to play around, if you think you're a genius and you've done some homework, and you want to own some particular stock, take 10% of what you have. If you have $1,000, take $100 and go ahead, invest in it. That seems to be a threshold most professionals are comfortable with, because everyone has the itch to be an investor. Being a long-term investor, buy and hold in index funds is wonderful and correct way to go. Certainly the academic literature indicates it is. However, it can be boring. People want a little more action. So you'll see the investment professionals usually recommend take 10% of your money and go ahead and try to make a bet and see if you can. But I think you'll find over the long term, and I'm talking decades, the academic literature is overwhelming. Long-term buy and hold beats anyone, passive investing beats active trading, going in and out of stocks, because market timing does not work long-term. And I'm talking decades. You have to be right going in and going out. Try doing that a lot. It is very difficult. And I have a lot of respect for anybody who is in that business and can do it in any way successfully. But over the long term, you'll find you're very much in the minority in terms of beating the indexes and beating passive strategies.
All right, well, that's definitely helpful information for new investors. Our last question today is, what is your favorite part of your job?
I've made no bones. It's IPOs. Being on the floor of the New York Stock Exchange is a very privileged position. I've been there since 1997. That is a lot of bell ringings. I always joke about this. What would you give to meet all of your heroes? Every rock star, every politician, anybody, CEO. I've met them all of them. It's a lot of bell ringings since 1997. But my favorite is anyone coming for an IPO where the company's going public, because this is one of the biggest days. It may be the biggest day other than getting married of their entire life, or their first child's born, because this is the day that basically they announce, I've made it to the world. It's a very big ceremony to go public at the NYSE. Brought in, you have a big reception. If you ring in the opening bell, you have a breakfast in the boardroom, which is stunning, 100 feet long room with 40-foot ceilings designed by people who work for Louis Tiffany. It's just a stunning room to be in. And there's a little presentation, the head of the stock exchange or the vice president will come out and say, welcome to the New York Stock Exchange. And the whole thing is very carefully choreographed. You have arrived, basically. And then they bring their largest shareholders in and some important staff people, 100, 200 people. And then they go down in the elevators and they go on the floor and they sign the book, the NYSE book, under the podium. And then they take the principals up to ring the bell on the podium just above. There's a whole ceremony about how you ring the bell and hold the bell down, and then you hit the gavel. It's all designed with the ceremony in mind. And then you go to the post. When the stock starts trading, you wait for the stock to start trading. They build the book. I've stood in front of these posts for decades. And my favorite part is just standing next to these people. I've met everybody, in oil magnates, or people looking for cures for cancer, or insurance salesmen, or software engineers. It's an amazing amalgam of people who go through the NYSE. It's always kind of interesting just to say hello to people. And what I noticed they are doing, every single one of them is staring at the post, looking at the panel above where their stock is trading, because there it says XYZ stock priced at $20, indication for opening 22 to 24. And you know what they're doing? They're figuring out their net worth, because suddenly they've realized they're rich. And you might say, well, how rich? Well, it depends, but it's very typical. Most senior executives, they'll be getting, tens and hundreds of thousands of shares, which granted is part of their compensation. So I mean, just do the math here. If somebody, this is a minimal number, would get 100,000 shares and the stock opens at 22, they're worth 2.2 million. And that's the low end. There are founders who would come into these things where they're worth 20% of the company. And in that case, they could be worth, suddenly when that bell rings and they start trading, they could be worth billions. So the numbers are all over the place, but I can assure you it's that they look like this. They're just figuring out, oh my God, this is like amazing. I'm wealthy. I've made it. And their kids are standing next to them and they're cheering and people are taking pictures and they're back slapping backs. And it's a wonderful slice of Americana. And it's a wonderful slice of the capitalist system at work. And people are happy and, babies are being kissed. And, it's my favorite part of the job. So there you have the answer. Someday I'll do a little behind the scenes. I've talked to the NYSE about doing this, about just doing a 5-minute program, trailing around somebody who's going public one day. But we'll do that. I've described it many times, but there's nothing like it to be standing there.
Yeah, I think people would love that, because you do have such a unique perspective, being there for so many years and seeing all of these different companies go public. And you've definitely been busy with that this summer with all the IPOs. So it's always great to see.
Yeah, this has been a really busy summer because a lot of companies have sort of gotten stuck in the pipeline over the last several years because interest rates are low. It's easy to keep these companies private for longer. The downside is a lot of companies should have gone public years ago, and the investing public would have benefited from the earlier growth stage. So a lot of companies that have gone public are now sort of middle-aged, and the early growth that they would have had if they'd been public, or the public investors weren't able to take advantage of that. So we saw a lot of companies, and have seen this year, and some of them by SPACs. And I think it's wonderful. I want more companies going public. I prefer a traditional IPO route over SPACs for various reasons, but we need more companies going public and earlier.
Great. Well, thanks, Bob, and thank you so much to everyone for tuning in for another Market Matters. And yeah, again, thanks for being with us, Bob. So have a nice weekend, everyone.
Great questions again.
Mm-hmm.
You guys are very smart. One of these questions is exactly the right question to ask for this week.
Yeah, so keep them coming, and we'll see you guys again in another couple weeks. Bye.
Thanks, Katie. Bye, everybody.